Gold is doing something we haven't seen in generations. As of April 2026, the yellow metal has shattered every traditional playbook, leaving investors, central banks, and even seasoned economists staring at the charts in disbelief. We aren't just looking at a price hike, we are witnessing a fundamental rebasing of what gold actually represents in a modern, fractured global economy. The numbers are staggering. Gold has surged over 140% since the end of 2023, recently pushing past the $5,000 per ounce mark and even touching $5,800 in certain trading windows. For decades, gold was the boring asset, the insurance policy you hoped you'd never need. Now it's the main event. But to understand why, we have to look past the ticker symbol and into the engine room of global finance. The first major driver is a massive structural shift in how nations hold their wealth. Central banks in emerging markets, led by giants like China, India, and Brazil, have been on a relentless buying spree. We are seeing a move toward de-dollarization in real time. These nations are no longer comfortable keeping all their reserves in U.S. treasuries or Western-backed assets. They want physical gold, held in their own vaults as a hedge against sanctions and currency volatility. In early 2026 alone, we saw countries like Uzbekistan and Malaysia aggressively increasing their holdings, treating gold not as a luxury, but as a strategic necessity for national security. Geopolitics has also hit a boiling point. The recent headlines regarding the U.S.-Iran ceasefire and the ongoing instability in West Asia have kept the fear trade alive. Even when a temporary 2-week truce was announced this month, gold prices didn't crash as some expected. Instead, they surged. Why? Because the market knows the underlying tensions haven't vanished. Gold thrives on uncertainty, and right now the world is more uncertain than it has been in decades. Whether it's the threat of supply disruptions in the Strait of Hormuz or the ripple effects of global trade tariffs, gold is the only asset that doesn't require a government's promise to be valuable. Then there's the bubble debate. The Reserve Bank of India recently flagged that gold's behavior is looking increasingly bubble-like. When an asset moves this fast, it attracts speculative money, retail investors and ETFs jumping in because they're afraid of missing out. We've seen record inflows into gold ETFs, particularly from the Asia-Pacific region, which is now a dominant force in setting global prices. When grandma in Seoul and a hedge fund manager in New York are both buying the same bar of gold, you know the fever has spread. But is it actually a bubble, or is it a correction? Many analysts argue that for years, gold was undervalued relative to the massive amount of debt and currency printing happening in the West. With U.S. debt reaching levels that many find unsustainable, and the Federal Reserve shifting its policy toward easing, the opportunity cost of holding gold has vanished. Since gold doesn't pay interest, it usually struggles when rates are high. But now, even with fluctuating rates, investors are choosing the safety of bullion over the yield of a bond. What we are seeing is a perfect storm. You have the stagflationary pressure of high energy prices, the flight to quality caused by regional wars, and a massive loss of faith in traditional paper currencies. Gold is essentially the world's way of saying, we don't trust the system. Whether it hits $6,000 or sees a sharp correction, one thing is clear: the era of gold being a sleepy background asset is over. It has reclaimed its throne as the ultimate barometer of global chaos. If you want to know how worried the world is, don't look at the news, look at the gold chart. It's telling a story that the world's biggest players are no longer willing to ignore. The yellow metal is no longer just a hedge, it's a global power move. As of April 2026, gold has shattered the $5,000 per ounce barrier, and the traditional financial world is scrambling to rewrite the rulebook. We aren't just looking at a price spike, we're witnessing a fundamental rebasing of what money actually is in an era of fractured trust and exploding debt. The most aggressive force behind this surge is the great diversification of central banks, led by the National Bank of Poland, which added over 100 tons last year, and powerhouses like China, India, and Brazil. Sovereign buyers are moving away from the US dollar at a pace not seen since the 1970s. For these nations, gold isn't just an investment, it's a strategic defense against sanctions and currency weaponization. By early 2026, central bank gold holdings have climbed to nearly 20% of total global reserves, up from 15% just 2 years ago. This isn't a temporary trend, it's a structural shift toward hard money that bypasses the Western banking system entirely. The rise of the BRICS Plus alliance has added a massive layer of complexity to the market. With the launch of the unit settlement system, a trade framework backed 40% by physical gold and 60% by national currencies, the bloc is actively creating a parallel financial universe. Since these nations control nearly 50% of global gold production, they are essentially building a gold-backed trade wall that creates a floor for prices that may never be broken. This alt-fiat trade is turning gold from a passive reserve into an active medium for international commerce. Geopolitics, however, remains the volatile fuel in the engine. This month, the market is reeling from escalating tensions in West Asia, with rumors of direct conflict and supply disruptions in the Strait of Hormuz keeping the fear trade red hot. Even when we see temporary ceasefires, the price of gold is refusing to drop. Instead, it's behaving like a risk asset, highly volatile, attracting massive retail interest and reacting to every headline with parabolic moves. In Asia, particularly China and India, retail demand is defying record high prices. Young investors are moving away from struggling property markets and into gold beans and specialized ETFs, viewing bullion as the only reliable store of value in a stagflationary environment. On the supply side, the situation is increasingly tight. Global mine output is hitting a plateau, and the easy gold has already been found. New discoveries are lagging years behind the price surge, creating a supply-demand gap that is being filled by aggressive institutional buying. Major banks like JP Morgan and HSBC are already forecasting averages of $5,400 per ounce through 2027, noting that the traditional inverse relationship between gold and interest rates has completely broken down. Investors are no longer choosing between gold and yield, they are choosing between gold and systemic risk. What we are seeing in 2026 is the culmination of a decade of fiscal excess, with U.S. debt levels hitting heights that many analysts now label unsustainable. Gold has become the ultimate black swan insurance policy. It's the only asset that doesn't represent someone else's liability. Whether you see it as a bubble or a long-due correction, one thing remains. Gold has reclaimed its status as the world's ultimate barometer of chaos. If you want to know how much faith remains in the global financial status quo, don't look at the stock market, look at the gold chart. It's telling a story that the world's biggest players are no longer willing to ignore.